Investors, welcome back. It's Friday afternoon again, and I'm wrapping up the investment week, what happened on the stock markets. And this week specifically, I'm going to speak about 5 topics. I'm going to cover 3 companies, specifically on their earnings. And as you can see from the title, we will discuss, in fact, a lot about retail stores, specialty stores like Home Depot, and also e-commerce with Alibaba. But I will also cover a legal story that relates to Meta and another story related to the Nasdaq, related to their trading processes as of December this year, which I think is also of interest for you. So let's get started. As always, very quickly, a very quick view at the recession watch that I do every week as well. So as you can see, and in the meantime, actually, you even have these indicators now as well in Vinley. So you see that the weekly economic index, which is a weekly measure of rough cut 10 macroeconomic indicators in the US, is still positive. So there are, for the time being, no signals of recession. So all good for the time being on that side of things. While at the same time, most of the analysts are expecting that in September, the chances of having the US Fed reduce the interest rates are probably unlikely because of high inflation, actually, including the fuel situation that we will speak about very briefly when we speak about Walmart as well. So let's start with Home Depot. So this is a specialty store, as you know. So they are selling a lot of, let's say, products for do-it-yourself at home, specifically in the US. So so what to say about their financials? Financials were pretty solid, I have to say, with sales up to 47.9 billion, up 5.7% year over year, which is pretty okay. The comparable sales were up 1.7%, which is a slight improvement. So investors were pretty happy, in fact, with the results of Home Depot. Earnings per share was also up 4.4% year over year, and they didn't change the full year guidance. A couple of concerns to watch before I cover the fundamentals of the company. So where investors nonetheless are paying a lot of attention to is that part of their results are coming, and you will see this also with Walmart, that part of their results are coming from a 730 million tariff refund that has actually been improving their quarterly margins, in fact. So that's something that, of course, that has to be taken into account because that will fade out in Q3 and Q4. The CEO is currently on sick leave. So for the time being, it's CFO and an exec VP, even who ran the investor relations call in a very solid way. I have to say that's a proof that the resilience of the company is there and the continuity is there. But of course, it's never good when your CEO is out for medical leave. One of the things that is interesting in the conversation with Home Depot, outside of the type of products that they sell, is really related that they really depend on the housing turnover. So housing turnover is actually how often people change their house in the US. So currently, since the last 4 years, the housing turnover is flat at around 3%. One of the reasons for that is, of course, that interest rates are high, so it's difficult for people to borrow money to buy a new house or to change the new house, so selling their own asset and buying a new asset. So it's something where even the CFO and the EVP were discussing in the analyst call that, of course, they would hope that the housing turnover would go up, but for the time being, for the last 4 years, it has been flat at 3%. And of course, as said, if housing turnover is flat, this is not good news for Home Depot because they're going to have less do-it-yourself, so consumers buying their products for doing themselves changes in their house and homework, those type of things. In terms of the share price, so you can see that currently the share price is, it's okayish. You see that from a valuation perspective, it's, according to Vinley's sensitivity analysis, it's fairly valued. It's not overvalued, it's not undervalued. So, but of course, you see what happens to the market and the market reaction. So there were mixed signals from the results of Home Depot this week. In fact, how investors felt about it, specifically because of the refund of the tariff and that house turnover is flat at 3%. Walmart, that's an interesting one. So Walmart, the revenues were up 5.9% year over year, which is pretty solid, you would expect, but in fact, not really. If you look at the results on the right-hand side, and I put here the results by segment, you see that the US, in fact, which is the biggest chunk of the revenues, let's say 80% of the revenues of Walmart are related to Walmart US. So there, in fact, it just grew at 3.5%, which is slightly above GDP growth and slightly above inflation. I mean, they do have international operations in Mexico, in China, and Canada. You see this. I mean, if you put them together, it's like 30 billion US dollars. There, the growth was, with the exception of Mexico, China, and Canada, were solid. I mean, beyond inflation. And Sam's Club, which is a wholesaler, there, in fact, also the revenues went up, and you see that Sam's Club is already close to 26 billion US dollars. So what is also interesting is that their e-commerce sales are growing. And again, when you are in a brick and mortar business like Walmart, of course, you have also to think about omni-channel strategies, and so their e-commerce sales have been growing, and advertising as well, in fact, so that's good news. They also have memberships, so paid memberships, and there, in fact, the memberships on Walmart Plus and also Sam's Club have been increasing, which is pretty okay. But the stock fell, actually. I'm going to show this to you in the next slide. So the market reaction was really not good about Walmart, because the US comparable sales, so let's say at same parameter, was only 2.6%, while investors were expecting something above 3%, in fact. And specifically also, and I've called this out here, where really the market, even compared to Home Depot, where the market really was unhappy about Walmart results, is that they have done an operating income of rough cut 700 million US dollars, right? So which is like 44 or 3% more. But then there is a but to it. There is, in fact, they have taken in a rough cut 3 billion tariff refunds benefits that they are actually planning to offset higher fuel costs. I mean, we know that the fuel, given the US-Iran situation, is expensive for the time being, and also that they are providing this so they are offsetting this towards customers. So they will not increase, because they believe that customers don't have the purchasing power to increase the cost. So they're gonna take the tariff refunds and take it into their cost of sales, actually. And that's something where also the market has been really unhappy about this. So you see here clearly, I mean, in the graph, before I speak about the valuation in Vinley, but you see in the graph that the market really reacted at rough cut minus 10%, to make it simple, on the latest earnings of Walmart. They were really unhappy about it. They are concerned about what they were reading. And in terms of valuation, I mean, if I look at Vinley's sensitivity analysis, you see that from a relative valuation, it is expensive. Price to earnings and price to free cash flow are beyond 30 to 40. And even on absolute valuation, on intrinsic discounted cash flow and future earnings, also there, in fact, according to Vinley's sensitivity analysis, the stock is currently overvalued. And again, you have to decide what you do with that information. Third one is Alibaba. So this big Chinese, amongst others, I mean, you know them, competitor of Amazon in China, but they also have a very strong cloud platform called Ali Cloud. And some of you probably know the Amazon competitor being AliExpress. So financials were up, but the results were not good. So they also took a hit. You see it here in the graph, if you see my mouse moving here. So the market really didn't react positively to their results. What was the reason for that? The reason is that their e-commerce group has only been growing the revenues by 4%. What is, I mean, very positive is that the AI, cloud, and compute has been increasing by 45%. But the issue is that there were two things which have been hitting their financials. I'm going to show this to you in the next one, but already mentioning it here, is that their operating income fell by 57% year over year. Two reasons: goodwill impairment and heavy AI investments. I'll start with the AI investments. This comes back every week now. Last week I was covering this, the week before as well, with tech companies. So, I mean, companies are spending huge amounts of money on AI. And so they have been spending 2.7 billion US dollars on AI. So this, of course, this has an impact on the cash flow of the company. And they took also goodwill impairment. So for those who would not know what is a goodwill impairment, goodwill is the premium that companies pay when they acquire other companies, right? So they buy the balance sheet for a certain, let's say, fair value of the balance sheet, and everything that they pay on top as a premium that is not fairly valued, that is actually booked as goodwill in the balance sheet of the acquirer, in this case Alibaba. As it is I think it's a half-year report, so they haven't disclosed too much details. I was reading their financial report, so they have not disclosed a lot of details about the goodwill impairment, but it's probably a valuation that they had to reassess, and they said, okay, let's impair this, and they took a 1.2 billion US dollar hit on the goodwill impairment. So that's pretty steep, actually. So this explains why the results are not good. If you look at earnings per share, so like 3 months ending in June 2025, so 12 months ago, and looking at that quarter, let's say between April and June 2025, they had an earnings per share of 2.32 renminbi on in terms of profits per share, and now on this quarter, so April 26 to June 26, they only had 0.56 renminbi of profits, of earnings per share. So that's, and this is even non-cash, right? So it's not cash earnings, these are non-cash earnings. So this is pretty tough, actually. So yeah, so that's something where, despite having AI, cloud, and so Ali Cloud actually, and the compute as well, growing at 45%, investors are concerned about the amount of money that Alibaba is spending. You see it here. I mean, I tried to make these videos not too complex, but again, it's about practicing your eye as well as serious investors and smart investors. So you see here, just by looking at on the top, you have the income statements for the quarter, where you see that indeed their revenue has been growing by 9%, but the income from operation has come down by 57%, what I was just mentioning a couple of minutes ago. When you look at the cash flow statement, I just took the highlight of the cash flow statement. You see that they have, so the free cash flow was at minus 18 billion renminbi. So I will call it the second quarter, calendar quarter of 2025, while the second quarter of 2026, the free cash flow was negative by 44 billion renminbi, which is negative by 6.5 billion US dollars, which is actually huge. So you see that it has been multiplied by 3, which explains why investors are not happy about the results. One of the things that I want again to mention as smart investors, that's the type of thing that we shall look into. In Vinley, we do have, and you can see how the company allocates capital. So we have created this graph that you can find under the financials when you analyze the company. And on the annual, so this is 12 months trailing, you see the cash circulatory system. And you see, in fact, that 88% of the operating cash flow has gone into reinvesting. That's the AI story. And they're launching a new Quen model. So those type of things. And in terms of debt, actually, you see that the amount of debt has increased, and so that's also not good, actually, when the company is nearly reallocating completely 100% of its operating cash flow into investing cash flow, and on top of that, it increases the amount of debt while continuing to paying out cash dividends. So that's really where even myself, I would say concerned how management actually allocates capital. But as always in the AI story, it's a bet, and we will see what will be the outcome of that. Two last stories that I want to highlight. Those are not now about earnings, but Meta, that I think I covered Meta a couple of weeks ago in one of my weekly Vinley Radars. So Meta is facing actually a landmark trial by, if I remember, it's 4 states, California, Colorado, Kentucky, and New Jersey, who are leading a 29-state coalition, because it looks like Meta, and again, I have to be very honest, I'm not the biggest fan of Mark Zuckerberg and the products of Meta and the addiction. I mean, even if you remember the case where the Meta AI policy has leaked, and that it was okay for Meta AI agents to have romantic conversations with children. That's something that has surfaced by Reuters a couple of months ago. I mean, I'm not the biggest fan of Meta, I have to be honest about it. And so the states are now filing against Meta, because apparently they have, amongst others, collected unlawfully data of children below 13 without parental consent. Again, it's not the first time they are doing this. And that they have been actually creating products that were creating addiction towards children. And even a safety engineer from Meta has been doing a testimonial that was kind of claiming that this is potentially true, in fact. So we'll see. What are the problems here? The problem is that, first of all, Meta has already lost two cases this year, a 6 million verdict in LA in March and a 567 million penalty in New Mexico. That's huge. And here, apparently, it could be that the maximum theoretical penalty could be up to 1.4 trillion. And why I'm calling out this number? Because the current market cap of Meta is 1.390 billion trillion US dollars. My apologies, not billion, trillion US dollars. So let's see what will happen here. But this is again bad news for Meta shareholders. And so the market has not been reacting positively to this, of course. Last point before we wrap up for this week. So the Nasdaq has been announcing that as of December 6th, if I remember well, there will be probably, and this of course is pending the Securities and Exchange Commission approval, that they're going to have a 23-hour trading session. So it means that it will be nearly, the markets will be, or the Nasdaq stock market will be open nearly all the time. So that's something that they want to go with, because they believe that having just a couple of hours trading session, this is no longer how markets work. So let's see what is the outcome. But of course, this will have an impact, because stocks that are traded on the Nasdaq will be traded nearly 24/7, in fact. So that's something just that I wanted to give you as an update. All right, wrapping up here my weekly Vinley Radar. I hope that, as always, you liked it. And as always, if you like this weekly Vinley Radar, and in order to help us, please subscribe to the channel, like the video, and feel free, of course, to submit any comments that you would have in the comment section. Thank you very much, and talk to you next week. Thank you.